Dear students, this lecture is going to be a refresher of what I have already covered in the class. This will benefit, of course, those who had missed the previous classes, but also it's going to be a refresher for those who are present so that you can understand and appreciate the later lectures better. So, I will go through this lecture pretty fast because I'm just trying to provide an overview of things and I'm not diving as deep as I had done in the class. In any case, this class, as you know, is about developing financial intelligence in leaders. So, what do we mean by that? We are essentially talking about the importance of developing financial literacy in leaders. And you all are organizational leadership students. So it is important that you understand some of the basic financial concepts. So when numbers are presented to you, you are not feeling overwhelmed or anxious. Now, when it comes to financial numbers, I have seen uh, leaders, especially those who haven't had any finance background, tend to get anxious. They either blindly believe what is presented to them or are just too anxious to ask even clarificatory questions so that they can understand and evaluate the validity of those numbers better. So, this is a problem amongst many leaders who haven't had a thorough training in finance. Now, I must say that this class is not focused on making you an expert in finance. Uh, I'm not going to teach you how to close books, how to um, write a balance sheet, or I will not be asking you to memorize any accounting formulas. Uh, those are things that are covered in an accounting course. This is more of a course that focuses on developing some of the basic foundational skills and knowledge so that uh, you don't just fall into uh, the trap of being taken for a ride when it comes to financial matters. And you can do that better when you understand some of the finance topics better. So it's about having enough understanding so that you can ask the right questions, so that um, you can make better decisions as a leader. So that's essentially what the focus of this entire series of lectures is. So, one of the most important idea to internalize is the fact that finance is not a science in the sense that it being absolutely objective. No, finance is not absolutely objective. There is a lot of judgment that is involved in finance. It is not objective math. Yes, those judgments are applied within a framework of rules, but then it is still subjective judgment, which means that there can be a lot of ambiguity or disagreement with respect to how we make those judgments. Now, as students of organizational leadership, you are familiar with performance appraisal, for instance, where, let's say, when you are going through a subordinate's performance report, you may be evaluating the person's performance on certain parameters, certain metrics. So you may be rating mm, the subordinate on a particular scale. Now, when you see those summary ratings, they are numbers, but they are ratings that involve judgment. Uh, Now, but when you see some financial numbers with respect to, let's say, profit, you automatically assume that it does not involve any judgment, which is not always true. Um, yes, there is an objective aspect of many financial numbers, but there is also a subjective aspect. And that is the part that I am trying to emphasize. So, once you are aware of this subjective part of finance, then you will be more open to asking the right kind of questions, and you will not blindly um, accept anything related to finance when you uh, come across those numbers. So, if we continue that same line of thought, here in this slide, you see some of the things that people assume about finance. They assume that finance involves only objective facts. That's not true. What actually is true? Yes, it involves facts, but it also involves subjective judgment. So, numbers are not neutral. Numbers reflect the decisions or evaluations of people. So, I have already mentioned this, but imagine two people doing performance review of one person, right? Of the same employee. Same person exhibiting same kind of performance, same behaviors, same actual results, same actual task behaviors, citizenship behaviors. Um, but when we will look at the appraisal um, conducted by two different managers, we will see different ratings for sure, right? Because they are um, different ratings from different people. Uh, so what then we see is that there was some judgment involved. There was some perspective from involved from these two different people, due to which we will see some similarities but some differences in the way the ratings were provided. People don't think that to be the case with finance, but finance works exactly the same way. So, uh, profit is not just an objective number, or many of the other parameters that we will check also. They are not just objective number. There is some subjective judgment that goes into figuring out what the how to calculate the estimated value of profit. So, profit should not just be seen as a measurement. It should be seen as an estimate. It's a calculated estimate, right? So, again, profit is just one of those terms, but the that should be a good illustration, because profit is something that businesses are all about. So, this may make things very confusing, but this is not necessarily the bad news. It's in a way uh, good news. Because it shows that the financial information uh, has some subjectivity involved, which means then you can be intelligent in understanding them better. You can be intelligent consumers of financial data, and you will know what to ask. How did they arrive at those numbers? What assumptions did they make to arrive at those numbers? Those are the kind of questions when you will ask, you will be um, gaining much deeper insights about the business, about the operations, and consequently, you will be able to make much better decisions. So, that's the basic idea behind this whole endeavor. So, to illustrate these concepts, we'll go through few examples of some of the financial concepts, and we'll illustrate them through some practical real life examples. One of the examples that I went through in the class in a fairly detailed fashion was the restaurant business analogy, right? So let's start with the topic of revenue. Revenue is should be a very simple or straightforward term, which is the money that your business generates through whatever it is that you are selling. You may be selling goods or you may be selling services, but in return of those goods and services that you sell, you get money, and that money that comes, that income, that is your revenue. Seems to be pretty straightforward. So, you generate revenue. When you subtract the expenses, uh, if revenue is higher than the expenses, you make profits. If your expenses are higher than revenue, you are making losses. Should be pretty simple and straightforward. Yeah, but it isn't as straightforward always, right? Because there is ambiguity, or there is judgment involved in when we can count something as revenue. Essentially, it boils down to when can you officially record something as a sale. The rule is that you record revenue, as you can see here, when the product or the service is delivered. But for a simple business like that of a restaurant, it may be fairly straightforward, although it can be complex even then. So, uh, quickly, when I call the restaurant, make a reservation, maybe even give my credit card details for the reservation, uh, can we count that as revenue? No. I reach the restaurant, maybe it's a restaurant where you pay first and then eat. Um, when I pay for what I'm purchasing, is it a revenue? No, we still cannot count it as revenue because, as per the rule, excuse me, revenue is recorded when the service is delivered. So, when the waiter brings in the food, or when I'm delivered the food and when I'm eating it, that's when we record that service has been delivered and consequently revenue has been earned. So, um, just when you are paying your bill, that's just cash exchange, cash changing hands, right? That's not revenue. So there are these rules that um, have to be abided by. But as I was saying, this was still relatively simple. But many a times things can be very complicated because many a times sales do not happen at just one point of time. It can extend over a fairly long period of time. Imagine you are some software company selling, say, a 4-year contract um, on the software product that um, bundles the implementation, the licensing of the software, and the ongoing support. So, how will you count the revenue? Even if the person who bought the software paid in advance, can you count it as revenue? No, you cannot, because the services haven't been delivered yet. In fact, they may go on for 4 years. So, if I count everything, my revenue in the very first year itself, then I'm artificially inflating the revenue and consequently maybe my profit. So that's problematic. But if I am following the rules properly, then uh, maybe as and when different services are delivered, maybe I would need to stagger it, or maybe I would count it as a revenue after the entire period of 4 years, because that's when services have been fully delivered. Uh, which is less likely to happen, but at least once the services have been delivered for the first year, then I can count the corresponding amount of money for that period as the revenue for that year, and so on and so forth. So, what you can see here is um, some judgment being made about when and what to count as revenue, which then has implications on your profits, or what numbers you see in your profits. Now, let's go to the expense side of things. So, the example again that we discussed in the class is that of you purchasing a car for your company. Your company may have a fleet of 50 cars, but you are purchasing one more car. Let's say that costs $40,000. So that's an expense, um, and you would need to spend money to be able to earn money, which is all fair. But how do you show that expense? Is it what we call an operating expense, or is it a capital expense? So, when we are talking about operating expenses, we are talking about day-to-day expenditures that uh, you or the business incurs to run their daily operations, to run their regular normal operations. So, should you count this purchase as an operating expense, or should you count it more as a capital expense, which is in a form of investment, um, for which um, you will get returns over the years? It's seen more as an investment. It's not something that you are um, um, you, you need it for your daily operations, right? So the car that you purchase, you may be using it in your daily operations, but um, it is still should be treated as an investment, right? Um, it's an asset that you are purchasing. So yeah, the capex or capital expenditures are another way to think about it, is that it's an asset that you are purchasing. So the asset may appreciate, which may happen in case of land, or depreciate, which can happen with respect to equipments like cars, and or your computer, or an aeroplane, whatever that you are purchasing, right? Because there's wear and tear of these machines. So the value each year would reduce. So my point is, if you count the entire 40,000 as expense in this particular year as an operating expense, then uh, your profits will not look as good for this particular year, right? Because you spent so much of money, $40,000, for a small business. But the following year, it will show your profits will look good because there's no such expense in the following years. But if you are showing this expense of $40,000 spread out over 5 years, like which then is $8,000 per year, then every year uh, you are treating it as a form of expense that shows in your statement. So uh, this is how you should be showing your investment, because it's capitalizing an asset and depreciating over 5 years. So it matches the cost of the vehicle, and that's as it is generating value. So anyway, these differences in the way we um, designate something either as an operational expense or capital expense can have significant uh, changes, can make significant changes to your overall profits for any particular year. So many of the scams, the WorldCom scam and many other scams, um, have been related to such uh, such decisions that finance managers and accountants made about either the revenues or the expenses. So any expense, when if it's pushed to the capital investment or the cap expenditure, then it will not show as an operational expenditure, and it will artificially inflate your profits, even if you did not actually make as much profits. So, but there are certain rules and regulations about what and when you can include as expenditures in these different categories. So, but the key point that I want to highlight here is the involvement of judgment. So, you should be asking these kind of relevant questions to figure out if uh, they have been classified in the correct way, so that the numbers that you see on your financial statements are more in consonance with the accounting standards of the nation or the world. In the class, we went through several cases, the Xerox case, the WorldCom case, and the airlines case related to depreciation of planes. So I won't repeat those things here, but they all pertain to the same topics that I just touched upon. So for leaders, there are a set of 4 questions that you can ask to make better financial decisions. So, what are those 4 questions? That's what we will focus on next. They are pretty simple and straightforward questions, but very important questions, and they will help you make better sense of the financial information that you are presented with, as well as make the appropriate decisions pertaining to them. So these are the 4 basic questions that your textbook suggests you should be asking to understand and evaluate any financial number better. So, the first question is, what assumptions went into the number that we are being presented with? So, every financial figure is built on beliefs about the world, about the business. So, how long, for instance, the equipments that you have purchased will last? Will it last 5 years, 10 years? When will the customers pay? What percentage of warranties will be claimed when you are selling any product? So there are assumptions that go into um, these questions, these decisions. So they are essentially then estimates, right? So any number, some part of those numbers are solid, like the exact amount of cash that you have in your bank. That's a fact. But many of the other financial figures that I was talking about, they involve estimates, right? What is the useful life um, that is remaining in your equipment? That's an estimate. That's but that impacts the depreciation rate that you are putting on the equipment, right? So if you are uh, letting it depreciate at a faster rate, then that will have one set of impact on your profit statement. Uh, Whereas if you are letting it last for much longer, you are showing it to be lasting for much longer, which it may or may not last, depending on which direction your estimate is. You realize there is a bias. Bias could be in the optimistic direction, or bias could be in the pessimistic direction. Same thing happens also on the sales side. Salespeople, they often tend to overestimate the pipeline of their pipeline that will get converted to sales. But as we had mentioned before, just receiving the money or having signed a memorandum of understanding does not constitute it to be considered a sale, right? You can't count that as revenue. But um, you have to ask those questions to make sure that those proper guidelines are being followed. Um, so, but even when things are within the legal norms, as we discussed in case of Xerox and some of the other cases that we discussed in class, um, there is still some amount of bias involved, and depending on which direction it is skewed, it can either inflate the profits or deflate it, or show that you are doing losses. So for any number that you see, you should also be asking, okay, I understand what the assumptions are. I understand if this is a fact or an estimate. If it is an estimate, I understand now which direction it is skewed or biased. So, what decisions should I be taking now, um, knowing that the uh, estimates are biased in a certain direction? So that should inform the strategy that you will be taking. That will also inform the kind of investment you can or cannot make over the um, corresponding years. That will inform even the amount of operational expense that you will allow or will not allow to happen. Or you may decide to freeze expenses in certain accounts. Though that money would still be there, but by freezing it, for instance, you will not be incurring those operational expenses and can continue to show that you are making profits. So these are not necessarily things that I am recommending, but these are different kind of strategies that or tactics that many leaders employ to make sure that they are showing the profits for their organization. The key thing is to be following the legal guidelines that is there in your country. The next couple of concepts that I want to cover is about shared costs. So there is this term accrual, which simply means recording a cost in the period that it was incurred, right? And not when the check was written. Um, so let's say your organization uses electricity. All organizations would use electricity, of course, but uh, so they right now we are in the month of April. So let's say for March, your organization used electricity throughout March. The bill arrives though in April. Now, under accrual accounting, your March income statement still shows that electricity cost because the all your machines ran in March. The cost is then recorded in March, even before the invoice is paid, which is happening in April. So these are the kind of rules. Allocation is how you split a particular cost across business units or across time periods or across different segments. I had discussed extensively about my job involving research and teaching, and how do we divide what part of my salary should go into research expenses and what part should go into teaching related expenses, and how that can then either inflate or deflate how efficiently different operations within our university are being run, right? But even a CEO, let's say, earns $400,000 per year, and your organization has 4 divisions. So the CEO of the organization, 4 divisions. Now, how much of that salary should show up as a cost for each division? There is no objective answer because those divisions are not equal in size. Rarely would that be the case. Or even if they were equal, the time investment for different divisions may be very different. So it's a choice that would be made, right? It's a choice, and that choice would affect which division looks profitable and which division doesn't look as profitable, right? So this next figure that you see on the right, the let's say you spend 6 months developing a new product, and your salary is $60,000. So if that same $60,000 gets charged, so it becomes an operational expense, it gets charged to the product's cost. The product looks very expensive now. So, which would then drive up the price of the product, or uh, there may be a demand to reduce the headcount so that the product price is not as high. But if we allocate that same $60,000 uh, to R&D, research and development, right, overhead, now the development budget for that product will look expensive, potentially maybe even triggering costs cuts in the future R&D investment. But the product itself looks cheaper because that price was taken into account in R&D budget and not in the um, product development budget. So it's the same product development, it's the same reality, but it is being reflected differently based on how it is classified. So that's the part that you need to understand as a leader, so that when you see some cost showing up on your statement, on your division, you know you should know whether it is a fair thing that has been placed on your division, or should it change. Those are the kind of questions you should be asking to make better decisions. Here's another example of how uh, a particular estimate can dramatically change whether you are making profits, whether you're showing profits or showing losses. So we are talking about uh, judgment related to depreciation here. So the equipments that companies use, they will of course not last forever. So their value needs to be depreciated every year, and the logic should behind it should make sense. When your company buys anything, it any major product or equipment, it will be used for years. So it doesn't make sense to charge the entire cost of that expensive product to the year of purchase, because if you do that, then it will show as major expense incurred in that year, uh, resulting in losses. But when we spread out that expense across years, it is a more fair thing to do. So the cost gets distributed also over several years. So the depreciation formula helps with that. So this is the one of the examples from your book, and we'll go through it quickly. So let's say you are a business owner where you use trucks for your business, and let's say this particular month your business earned a revenue of $10,000, and the cost of the goods that you sell was $5,000. So the gross profit, which is $10,000 minus the revenue minus the cost of the product sold, is $5,000, right? Pretty simple, straightforward thing. But then there can be other expenses, other overhead expenses, general expenses like rent, of your property that you are using, marketing, and so let's say those are another $3,000. But now we also need to take into account the depreciation of the truck that you purchased beginning of the month. So let's say that was $36,000. Now, if um, you are expecting to use it for the next 3 years, what you would do is you would spread the cost over that time, right? So $36,000 over 3 years means over 36 months. So essentially comes to $1,000 per month. So the depreciation for this particular month would be $1,000. So 5,000 gross profit minus 3,000 for expenses minus 1,000 for depreciation. So you are showing a net profit of $1,000, which you can see for the 3-year life, if that's what I estimate for the truck. But if I estimated the life of the truck only to be 1 year, or it may not necessarily be an estimate in the strictest sense, but if I am accounting for everything in just 1 year, then I will not be showing a monthly profit of $1,000. Rather, now that same $36,000 have to be divided over 12 months only and not 36 months, which is $3,000 per month. So the depreciation here would, instead of $1,000, will be $3,000. So from the gross profit, we would need to subtract the expenses 3,000, but also a depreciation of $3,000 for this month. So total 5,000 minus 6,000 will be $1,000 loss. So there will be a net loss of $1,000 for this month. Now, just the other scenario, if I divided that cost over 6 years, right? If I'm seeing that it will depreciate fully over 6 years, then that same 36,000 is divided across 6 years. So the monthly cost comes to $500, right? So depreciation is only $500 instead of $1,000. So in that case, the net profit becomes $1,500 for this month as opposed to 1,000. So the point here is the just same product or rather same equipment that was purchased, but depending on how you estimate, we see completely different profit pictures. And all these three options are technically defensible. So this then uh, can skew results in one direction or the other. And we had also discussed the case of the waste management 20,000 trucks, and how they extended the estimated useful life of each one, and how that helped them show more profits, phantom earnings. So anyway, these are some of these kind of judgments that people make, and how that then impacts the profits or losses that they show in their profit and loss statement. And here there's another type of accounting judgment. So we are talking about valuation. Specifically, how do you put a dollar value on a business or any major asset? So this comes most relevant. This becomes most relevant when you are selling a company or when you're buying a company. So that's when this becomes really important. Or when you're buying a major asset or anything to that effect. So there are three main approaches about figuring out the value of anything. But none of these approaches, are um, without weaknesses. So the first one, how should I figure out the value of my company? Maybe I can compare it to businesses of similar sizes, similar public companies. The if my company is a public company, the problem here is that markets are often irrational. So if the current market is overpriced, my benchmark will also be overpriced. So plus, no two businesses are exactly the same. So the internals can be dramatically different, even if they are of the same size and they are working in the same industry. So uh, another approach, with respect to valuation of a company, could be mm, projecting the future cash flows, and from that we go backwards and calculate the worth today. That's a problem here as well, right? Tiny changes in the discount rate that we calculate can produce enormous differences in the final valuation. And future cash flows are just projections. They are uh, essentially stories that might not even happen. So they are built on a lot of what assumptions about how the market will grow, or what the margins will be, and how the market conditions will be. Mm, all the subjective estimates. So again, even there we can go completely wrong. Um, the third approach, about okay, so let's try to be as objective as possible. Let's just add up the value of all the things that the business owns currently. But even there's a problem, right? The most valuable parts of the organizations, especially something that we have discussed a lot in our earlier semester in context of strategy, is talent, is the brand reputation, the proprietary knowledge. Many of these things can not easily be quantified or imitated, cannot easily be replicated. So, how are you going to find, um, assign some value? It's going to be extremely difficult. Um, so, you understand that each method can produce um, different estimates of the same business, and that's the nature of finance, which is what I am trying to um, explain in this video. Uh, you are hopefully realizing that there's a lot of subjectivity involved. There are a lot of assumptions, lot of estimates, lots of biases um, that are involved in everything, including um, with respect to how you value something, or how much do you value a particular business. So, hopefully, this is giving you some good insights about the process. So, let's go through a few points on why does this all matter? Why do you have to put in all the effort to gain financial literacy? So we'll go through a few quick examples that will give you some insights about why this is so important. So your textbook, of course, talks about how people who do not have financial background, the non-financial managers, they score very poorly on finance related matters when they have been examined. So This, but is not necessarily a critique of their abilities, but the kind of assumptions that we often have about finance. But we'll come to that in a bit. The important thing is that uh, it is important to understand these the financial health of your organization, of your division, um, as leaders, because that will help you form better strategies, that will help you make allocate resources appropriately for different things. So challenge the numbers as opposed to getting challenged by numbers. So it's all about figuring out which of these numbers are actual factual numbers and which of them are estimates, which I have already discussed. So, but the third point, once you have correct knowledge about these financial numbers, then you can use them to figure out to make budgetary decisions, about how much of budget to allocate where, or what would be the return on investment on any particular investment or any particular initiative that you are planning, and so on and so forth. So these are all important information um, that will, excuse me, help you with respect to leadership decisions. In very simple terms, uh, power becomes much more evenly distributed, or it's more balanced when you have these financial skills, when you have this financial understanding. So you are not completely relying on your financial team. So we discussed a lot about strategy earlier in the semester. So when you incorporate finance into your strategic decisions, they will be much better decisions, right? They will be better choices, and they will not be just based on some hunch, or and leadership is a lot about achievement of goals, about shared goals. So you will be able to align also people around those shared goals, because without uh, incorporate, incorporating the financial numbers into your strategic discussions, um, or without incorporating these financial uh, aspects into any of these decisions that you have to take in an organization, uh, the discussions often become political, right? They um, are not based on the merits as much as they tend to be based on certain beliefs about um, different resources, or why something should be done or why something should not be done. Um, while those political or ethical decisions are fair, but we also have to take into account um, whether those are feasible things to do, right? So when you incorporate the financial aspect into those decision making process, you will have greater influence into the whole process. So that's what I would like to emphasize. The thing is that many people think that they are just not a numbers person, especially many people who work in HR area, or people who haven't had the mm, finance management or accounting training. But as hopefully you would have realized, this is less about mathematics, it's less about arithmetic. In fact, the kind of mathematics that's used is simple addition, subtraction, multiplication, which can be done easily on a calculator or your phone or whatever, right? So the financial literacy is more conceptual, um, and it's more uh, about knowing the meanings of the different financial terms and the kind of decisions that go into um, estimating those numbers. So that is the part that is more important than the actual calculation. Actual calculation is anyway very easy. So that's the part that I want to emphasize. So the other objections that your textbook talks about probably are not as critical, but yeah, I will just quickly go through the last one, which is a common excuse that you tend to say not only with respect to this, but about anything. Typical excuse is I don't have time and I've been so busy, which is a fact. We cannot deny that we can be extremely busy. But the point is that we have to find time for these things, to understand these things, because they will catapult our effectiveness in a big way. So we have to prioritize um, gaining more knowledge about the financial aspects of the business. The last thing that we'll go through in this lecture is some of the rules of financial reporting. And these are, especially in the United States, based on the GAAP principles or generally accepted accounting principles. That's the standard that is followed in the United States. It is the rule book for financial reporting. There is another standard, the international IFRS, but we'll touch upon that in a bit. So these accounting standards, they exist for just one primary reason, uh, so that uh, without these standards, every company can report whatever they liked. You cannot compare companies to each other because of all these subjectivity that is involved. So um, these standards, they um, try to come to an agreement about how we are supposed to estimate something. Now, there is still going to be subjectivity involved, but they still bring in some amount of objectivity to the process. You can think of it, analogous to sports. Without any rules um, of any particular game, how do we score? How do we know a particular team has done better or worse than another team? It's kind of those kind of things in the classroom context. For instance, the professor, I prepare a rubric based on which I evaluate many of you. So those are the kind of analogous things that you could think of to understand what these standards are talking about. But essentially, some standards that are used, they do not guarantee that um, all the numbers will be accurate and that you will everything is correct. No, but when you understand these standards, then it gives you a foundation for asking the right questions. So that's essentially what um, these knowing the standards will help you with. So based on those generally accepted accounting principles, here are the five most foundational principles that you should be aware of. So the first one is the historical cost principle. So you as a company will have lots of assets, for instance, but assets are recorded at what the company paid for them um, when they purchased it, not what they are worth today. So, uh, a, if you bought a building in 1985 that was worth $10 million, that's how it should appear in the books, um, and not its current value, which may be $100,000 or whatever. I'm just made up the number. So this makes the balance sheet, um, uh, should I say what, uh, more objective, and verifiable, right? Because then there will be a receipt for when you had purchased the. So because market value can fluctuate, and they can be very subjective. So this is the rule that has been placed because of that particular thing. So you are using facts and you are not using guesswork. Um, but the second principle is even more important, I would say, probably the most important principle in many ways. So you have to be conservative. So when in doubt, take the conservative approach, is what essentially is being argued here. So be pessimistic as opposed to being overly optimistic. So record your losses if they are likely going to be happening, but record gains only after they have happened. Right? So that's the kind of things. So imagine you, even as a person, uh, are worrying that you might lose $100. Well, you record it now. Uh, uh, as an expense, which will then show up as your loss later on. But if you are expecting to gain $100, well, you don't record it as a as a revenue. You wait until it has actually come, and you have provided the necessary service for that. So that's the critical thing. So you are always taking the conservative approach. And this is just the opposite of people's nature, because people naturally want to share good news and hide bad news. Especially, you can understand this when we are discussing wanting to project a positive image about our selves or about our companies to the outside world. So this rule protects against that. It makes the financial reports more trustworthy, and it protects against some overconfidence and exaggeration. The third principle should be pretty simple and straightforward, especially because we have discussed several examples before. The key is to be consistent. It demands that you use the same rules. You cannot be changing your accounting methods or standards or estimation methods repeatedly. So, because if you have changed the accounting standards, or for that matter, like for example, in case of depreciation. So earlier you were estimating depreciation happening over 10 years, and suddenly you decide we'll make it 5 years, and again after few years you make it 10 years. So there is no consistency, and then we are not comparing apples with apples. So that makes it problematic. So whatever rules that you are using, you have to use it consistently, because these constant changes, they often hide poor performance. And so this also connects to the next rule, which is demanding full disclosure from the companies. So if you are making any changes. Sometimes there may be an absolute legitimate reasons to make some changes, right? Maybe your maintenance budget for the fleet that you have increased. Maybe there's some new technology that came due to which there is better quality maintenance of the fleet of trucks that your company owns, for instance. So now there is a legitimate reason for you to extend the depreciation period, right? Um, but in case those changes happened, you still have to fully disclose it. And well, the only thing is that many a times these numbers don't show up in the main part. They often show up in the footnotes of the company report, and that is one of the important reasons why you should not only be looking at the main part of the report but also be going through the footnotes, is what is asked of leaders. And the last principle, materiality, uh, is essentially um, asking you to disclose the really important, the ones that matter. Uh, those things needs to be disclosed. Some of the trivial things not as important, right? So if your company is facing some huge lawsuit, that's important, that needs to be mentioned in the report. uh, some trivial loss of $5 that can be accounted for in the petty cash, not as not critical, right? So the important things have to be disclosed, and but sometimes you see the opposite things being done. Some of the trivial things get mentioned, but the real important ones aren't disclosed. So that is not full disclosure. So uh, by full disclosure, we mean especially the most important, the ones that really matter. Those have to be informed so that the investors and other stakeholders can make informed decisions, informed judgments about your company. So those are the most important gap principles. So, lastly, there is this other standard as well. So, gap is practiced in United States, but when we are talking about um, the world, there is the IFRS, or International Financial Reporting Standards. So, that is used in over 100 countries. So, both these standards are essentially the same in spirit, but they vary a lot in terms of the specifics. Of course, specific rules vary, um, especially pertaining to how you value something, how you value your inventory, how um, you do asset reevaluation, and so on and so forth. So the experts will know more about these things. But again, I'm sharing these things just so that you can ask the relevant questions. You can ask, did you do this based on IFRS principles or the GAP principles? And those are the kind of questions. When you ask, you will be getting better informed answers from the people who are sharing these reports with you.